This is not financial advice, rather a guide to financial literacy. Please consult with a competent finance professional in your jurisdiction at all times. Welcome back to the channel, everyone. If you're new here, today we're diving into the essentials of financial literacy. Whether you're just starting out on your financial journey or looking to brush up on the basics, this video is for you. We'll cover budgeting, saving, investing, and credit management. Now, please grab a notebook and let's get started. Understanding budgeting. Budgeting is the foundation of financial success, serving as a crucial tool for managing your personal finances effectively. It involves a systematic approach to tracking and allocating your income to cover various expenses, save for the future, and achieve financial goals. A well-structured budget helps you understand where your money goes, ensuring you spend within your means and avoid unnecessary debt. To start budgeting, the first step is to list all sources of your income. This can include your primary salary, secondary jobs, freelance work, rental income, or any other form of earnings. Understanding your total monthly income sets the stage for creating a balanced budget. Next, categorize your expenses into fixed and variable costs. Fixed expenses are those that remain constant every month. These typically include rent or mortgage payments, utility bills, insurance premiums, car payments, and any other regular commitments. These expenses are often non-negotiable and must be prioritized in your budget, since they are essential for maintaining your basic living standards. After accounting for fixed expenses, move on to variable expenses. Variable expenses fluctuate month to month and can include groceries, dining out, entertainment, transportation costs, and personal care items. While these costs can vary, it's essential to track them accurately to get a clear picture of your spending patterns. Identifying these expenses helps you pinpoint areas where you can potentially cut back to save more money. A critical component of effective budgeting is allocating money towards savings. Savings ensure financial stability and prepare you for future goals or unexpected emergencies. A widely recommended rule for budgeting is the 50/30/20 rule. According to this guideline, 50% of your income should be allocated to needs, 30% to wants, and 20% to savings and debt repayment. Needs are essential expenses like housing, utilities, groceries, and transportation. Wants include discretionary spending on things like dining out, entertainment, vacations, and hobbies. The remaining 20% should be dedicated to building your savings and paying off any debt you might have. Using the 50/30/20 rule, start by ensuring that half of your income adequately covers all your necessary expenses. If you find that your needs exceed 50% of your income, you may need to adjust your spending or find ways to increase your income. The next step is to allocate 30% of your income to wants. This category allows you some financial flexibility to enjoy life while still keeping your spending in check. It's important to enjoy the fruits of your labor, but moderation is key to maintaining a healthy budget. The final 20% of your income should go towards savings and debt repayment. This portion is crucial for building an emergency fund, saving for future goals like buying a house or retirement, and paying down existing debt. Building an emergency fund is a top priority. Financial experts suggest having 3 to 6 months' worth of living expenses saved to cover unforeseen events like job loss or medical emergencies. Implementing a budget involves more than just creating it. It requires ongoing maintenance and adjustment. Regularly reviewing your budget helps you stay on track and make necessary changes based on your financial situation. Life circumstances and financial goals can change, so it's important to adapt your budget accordingly. Use budgeting tools, apps, or spreadsheets to track your spending and monitor your progress. These tools can provide visual aids such as charts and graphs, making it easier to understand your financial status at a glance. In conclusion, budgeting is an essential skill that lays the groundwork for financial stability and success. By listing your income, categorizing your expenses, and following the 50/30/20 rule, you can create a balanced budget that ensures you live within your means, save for the future, and achieve your financial goals. Regularly reviewing and adjusting your budget keeps it relevant and effective, helping you navigate financial challenges with confidence and control. Saving strategies. Saving money is a cornerstone of financial health and an essential component of achieving both short-term and long-term financial goals. While saving can sometimes feel challenging, especially when dealing with tight budgets and competing financial priorities, implementing effective saving strategies can lead to significant financial stability and success. Prioritizing different types of savings and automating the process are key steps in building a robust savings habit. The first and most critical saving strategy is to build an emergency fund. An emergency fund acts as a financial safety net, providing you with a buffer to cover unexpected expenses such as medical emergencies, car repairs, or sudden job loss. Financial experts recommend aiming to save 3 to 6 months' worth of living expenses. This amount ensures that you have enough funds to maintain your standard of living while addressing any unforeseen financial challenges. Starting small is perfectly acceptable. The important part is to consistently contribute to your emergency fund until it reaches the desired level. Keeping this fund in a high-yield savings account can help your money grow while still being easily accessible when needed. Once your emergency fund is well established, the next step is to focus on short-term savings. Short-term savings are for goals you plan to achieve within the next few years. These can include vacations, purchasing new gadgets, home improvements, or saving for a down payment on a car. Identifying these goals clearly helps in setting specific savings targets and timelines. Short-term savings accounts, such as high-yield savings accounts or money market accounts, are ideal for these purposes because they offer liquidity and a better interest rate than a regular savings account. In addition to short-term savings, it's essential to focus on long-term savings. Long-term savings goals typically include significant milestones such as retirement, buying a home, or funding a child's education. These goals require a more strategic approach, often involving investment accounts like 400 and Onyx, IRAs, or other retirement savings plans. For retirement savings, contributing to employer-sponsored retirement plans, especially if your employer offers matching contributions, can significantly boost your savings. Compound interest plays a crucial role in long-term savings, as the money you invest grows exponentially over time. One of the most effective strategies to ensure consistent saving is to automate your savings. Automating your savings involves setting up automatic transfers from your checking account to your savings account on a regular basis, typically every payday. This method has several advantages. Firstly, it ensures that saving becomes a regular part of your financial routine, reducing the temptation to spend the money instead. Secondly, it eliminates the need for manual transfers, making the process seamless and less prone to procrastination. Most banks and financial institutions offer the option to set up automatic transfers, making it easy to implement the strategy. Additionally, consider using different accounts for different savings goals. Having separate accounts for your emergency fund, short-term savings, and long-term savings can help you stay organized and focused. This separation ensures that funds allocated for specific purposes are not easily accessible for everyday spending, thereby preserving your savings discipline. It's also beneficial to periodically review and adjust your savings plan. Life circumstances and financial goals can change, and your savings strategy should adapt accordingly. Regularly assessing your progress and making necessary adjustments helps ensure that you remain on track to meet your financial goals. Setting incremental milestones can also provide motivation and a sense of achievement as you see your savings grow over time. In conclusion, effective saving strategies are vital for achieving financial stability and meeting both short-term and long-term goals. Building an emergency fund, focusing on short-term and long-term savings, and automating the saving process are essential steps in creating a robust financial foundation. By prioritizing these strategies and making saving a regular habit, you can navigate financial challenges with confidence and work towards a secure and prosperous future. Introduction to investing. Investing is a crucial component of financial growth and wealth building, especially once you have established a solid foundation for budgeting and saving. Investing allows your money to work for you, generating returns over time and helping you achieve your financial goals. There are various investment options to consider, including stocks, bonds, mutual funds, and ETFs. Stocks represent ownership in a company and offer the potential for high returns. However, they also come with higher risk due to market volatility and fluctuations. Bonds, on the other hand, are loans made to companies or governments, and in the past and usually bonds are considered safer investments. While bonds typically offer lower returns compared to stocks, they provide stability and income through interest payments. Mutual funds and ETFs are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. These options offer built-in diversification, reducing the risk associated with individual investments. Mutual funds are actively managed by professional fund managers, while ETFs typically track a specific index and are passively managed. When starting to invest, it's essential to begin small and gradually increase your investments as you become more comfortable and knowledgeable. Consider using robo-advisors or consulting with a financial advisor to help you navigate the investment landscape and make informed decisions. Robo-advisors automate investment management based on your financial goals and risk tolerance, offering a convenient and cost-effective way to start investing. Financial advisors can provide personalized guidance and develop a tailored investment plan suited to your individual needs and objectives. It's important to understand that investing is a long-term endeavor. While it may be tempting to chase short-term gains or react impulsively to market fluctuations, successful investing requires patience and discipline. Stay informed about market trends and economic developments, but avoid making hasty decisions based on emotions or short-term market movements. By maintaining a long-term perspective and staying committed to your investment strategy, you can increase your chances of achieving financial success and building wealth over time. Understanding credit management. Credit management is integral to financial well-being, impacting your ability to access loans, secure housing, and even find employment. A pivotal aspect of credit management is maintaining a healthy credit score, which lenders use to assess your creditworthiness. Your credit score is influenced by various factors, including payment history, amounts owed, length of credit history, new credit, and types of credit used. Payment history holds significant weight in determining your credit score. Timely payment of bills demonstrates reliability and positively impacts your score, while late payments or defaults can have adverse effects. Consistently paying bills on time is crucial for maintaining a good credit score. Another critical factor is credit utilization, which measures the amount of credit you use relative to your available credit limit. It's advisable to keep your credit card balances low, ideally utilizing less than 30% of your available credit. High credit utilization can signal financial instability and negatively impact your credit score. Length of credit history also plays a role in determining your creditworthiness. Lenders assess the age of your oldest credit account, the average age of all accounts, and the age of specific types of accounts. A longer credit history provides more data on your financial behavior, enhancing lenders' confidence in your ability to manage credit responsibly. Managing new credit responsibly is essential for maintaining a good credit score. Opening multiple new accounts in a short period can raise red flags for lenders and lower your credit score. Each new credit application results in a hard inquiry on your credit report, which can temporarily decrease your score. Additionally, the types of credit you use contribute to your credit score. Having a diverse mix of credit accounts, such as credit cards, retail accounts, installment loans, and mortgages, can positively impact your credit score. This diversity demonstrates your ability to manage different types of credit effectively. Regularly checking your credit report for errors and inaccuracies is crucial for effective credit management. Monitoring your credit utilization and ensuring it stays below 30% of your available credit limit can help maintain a healthy credit score. If you're new to credit, consider options like secured credit cards or becoming an authorized user on a family member's account to begin building your credit history. In conclusion, understanding the factors that influence your credit score is essential for effective credit management. By implementing responsible credit habits, such as timely bill payments, low credit utilization, and avoiding excessive new credit applications, you can maintain a healthy credit score and improve your financial prospects. Regular monitoring of your credit report and exploring credit-building options can further strengthen your credit profile and pave the way for future financial success. And there you have it, the basics of budgeting, saving, investing, and credit management. Financial literacy is a journey, and every step you take brings you closer to financial freedom. If you found this video helpful, don't forget to give it a thumbs up, subscribe to the channel, and hit the notification bell so you never miss an update. Share your thoughts, questions, and comments. I'd love to hear from you. Thanks for watching, and until next time, take care of your finances and yourself.